Have you ever tried standing on one leg for a long time? Difficult, isn't it? Here's an interesting fact. A significant portion of market returns comes from systematic factors like value, momentum, quality, or growth, and no single factor leads the pack consistently. Relying on just one is like balancing on that single leg. It's risky and leaves you vulnerable. Hello, and welcome to this presentation on the SBI Quant Fund. Today's investment game isn't about stock picking or market timing. It's about disciplined, data-driven decisions. The SBI Quant Fund, with its multi-factor strategy, which dynamically combines factors like momentum, value, quality, and growth to create a balanced portfolio that tackles volatility and seizes opportunities. Let us first understand how factor investing stands apart from traditional investing. This slide highlights the key differences between traditional investing with factor investing across four key aspects: decision-making, diversification, risk management, and investing style. Factor investing uses a systematic, rule-based approach, diversifying across factors like value, momentum, quality, and growth. It ensures consistency through disciplined rebalancing and eliminates emotional biases. Traditional investing relies heavily on fund managers' judgment, which can lead to subjective decisions and variability. Let us see how individual factors perform and why combining them is a more effective strategy. As you can see, there is a cyclical nature of factor performance. No single factor consistently leads over time. For instance, from 2018 to 2022, the quality factor did well for the first 3 years, and value was the worst performer. However, this switched in 2021 and 2022 when value outperformed and quality faced significant underperformance. A multi-factor approach mitigates such risks by blending the diverse factors, creating a balanced portfolio that weathers downturns and adapts to changing market conditions more effectively. Every factor has its unique risk-return profiles. The left-hand chart looks at the volatility of different factors. Value has the highest volatility, while quality is the least volatile factor. The right-hand chart shows the upside capture ratio. Value captures significant upside, followed by growth. Quality, on the other hand, outperforms in falling markets. Value is known to be high-risk, high-return factor, while quality is a less volatile, stable factor. These distinct features of factors make a multi-factor strategy important as it diversifies the risk. Well, you may agree by now that a multi-factor portfolio combines the cyclical advantages of individual factors, diversifying risks while enhancing returns through one cohesive strategy. An important feature of a multi-factor portfolio is its tax efficiency. Unlike a single strategy fund, where an investor may need to switch funds based on changing market conditions, resulting in taxable events, a multi-factor strategy realigns the portfolio within the same fund, thus minimizing tax liabilities and improving overall tax efficiency. Now, let's take a quick look at the SBI multi-factor model and the four key factors driving it: momentum, value, quality, and growth. Momentum targets stocks with strong recent performance, expecting past winners to continue their upward trend. Value focuses on undervalued stocks that the market has overlooked, presenting opportunities for significant returns as the market corrects. Quality invests in financially strong companies with solid fundamentals, providing resilience and stability during market volatility. Growth seeks high-potential companies with strong earnings prospects, often disruptive businesses poised for rapid expansion. By integrating these factors, the model balances factors to adapt to changing market conditions and aims to maximize returns while managing risk. Here's a closer look at the engine driving the SBI multi-factor model. Every stock in the universe is ranked based on momentum, value, quality, and growth factors. These ranks are combined to create a composite Quant rank, which determines the stocks included in the portfolio. The process incorporates predefined risk controls, including active stock and sector weight limits, tracking error constraints, and liquidity considerations to avoid excessive concentration and illiquidity. Metrics like impact costs and stock liquidity are key to ensuring the portfolio remains adaptable. To maintain alignment with market dynamics, the portfolio is rebalanced monthly based on updated composite Quant scores. Dynamic allocation and rebalancing are pivotal to the SBI multi-factor model. Each month, the factor weights are dynamically adjusted based on their recent performance. Outperforming factors see increased allocation, while underperforming ones are reduced. To maintain balance and prevent excessive tilt, upper and lower bands are predefined. The chart highlights how the framework recalibrates whenever these limits are reached, ensuring that the portfolio remains well diversified and responsive to changing market conditions. This systematic approach allows the model to pivot dynamically, capturing opportunities presented by prevailing trends while mitigating concentration risks. The SBI multi-factor model's rebalancing strategy is one of its standout features, ensuring that the portfolio adapts dynamically to changing market conditions. This slide illustrates specific instances where the SBI Quant model dynamically adjusted factor weights in response to changing market conditions, highlighting the model's adaptability. Take the example of the pre-2008 period. The model emphasized growth and momentum factors, aligning with the bullish market environment. However, during the 2008 global financial crisis, the model pivoted toward value and quality, prioritizing resilience to protect against significant drawdowns. In this slide, we look at the pre- and post-COVID period. Pre-COVID, quality was outperforming most factors. However, post-March 2020, this changed considerably, with value coming back with significant outperformance. The model changed its tilt after March 2020 towards value. These rebalancing decisions are driven by a rule-based process, free from emotional biases. By responding proactively to market signals, the model not only captures opportunities, but also helps in mitigating potential downside risks. The chart showcases the back-tested point-to-point performance of the SBI Quant model versus the BSE 200 index across time periods. The results, which account for transaction fees and expenses, consistently demonstrate the model's ability to outperform its benchmark. For example, over the 3-year period, the model delivered 22.3% compared to 14.9% for the benchmark. The chart here highlights the 3-year rolling returns of the SBI multi-factor model compared to the BSE 200 index. This metric provides insights into performance consistency across periods, offering a more robust perspective beyond point-to-point. Results are encouraging. The SBI multi-factor model delivered returns above 12% in 77.2% of observations, compared to the benchmark's 58.9%, and returns exceeding 15% in 66.8% of observations. The benchmark's 39.6%. Additionally, the model has delivered an average rolling return of 19.8% compared to 13.5%. Moving on to the 5-year rolling returns, we see an even stronger case for the SBI multi-factor model's consistent outperformance against the BSE 200 index. The model achieved returns above 12% in 83.1% of observations, compared to the benchmark's 63.5%, and it delivered returns greater than 15% in 69.7% of cases, far outpacing the benchmark's 36.5%. Even the average 5-year rolling return of the SBI multi-factor model stood at 19.1%, significantly higher than the benchmark's 13.0%. What's more, the model has not delivered negative return at any given point in time. The maximum rolling return of 38.4% surpassed the benchmark's 24.8%. This analysis underscores the SBI multi-factor model's resilience and ability to consistently deliver superior performance over longer time horizons. This chart illustrates the drawdown of the SBI multi-factor model compared to the BSE 200 index, emphasizing the strategy's ability to navigate market downturns effectively while minimizing losses and accelerating recovery. A key highlight is the 2008 global financial crisis, a period of extreme market stress. During this time, the SBI multi-factor model experienced a significantly lower drawdown compared to the benchmark, showcasing its resilience in adverse conditions. Moreover, its dynamic allocation strategy enabled a faster recovery, helping investors regain lost ground more quickly and reducing the overall impact on long-term wealth creation. This demonstrates the model's strength in protecting capital during volatility and its ability to capitalize on market recoveries. Do take a look at the details of this fund. To conclude, investors who believe in India's growth story and want to invest in equity at a reasonable cost with the benefit of the fund getting reviewed periodically through a rule-based framework must look at the SBI Quant Fund. Thank you and happy investing. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.